Good morning and welcome to the Central Bank of Kenya Monetary Policy Committee press conference. The Monetary Policy Committee met yesterday and issued its usual press release, and today we have again our customary press conference that happens after the MPC. As is usual, the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, will address the press conference all the way through, and you're then free to please put in your questions through our usual model, which is Slido. Please put in your questions with your name and the institution that you represent. Without further ado, I'd like to welcome the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning and welcome again to this briefing following yesterday's Monetary Policy Committee meeting. You've already seen the press release that was issued yesterday evening, and I'm sure you've familiarized yourself with the contents of it. Today we will cover some of the principal concerns, the principal issues coming up as MPC examined the developments since the September meeting, and of course the evolution of the COVID-19 pandemic. So first and foremost is on the global developments. And here, progress is noted in the vaccination programs around the world. And I think we need the charts. This also reflects the reopening of the economies, and the developments also reflect the reopening of the economies. But you can see the vaccination, the progress of vaccination around the world. I think the global average is 54%, but you can see Africa is very much behind at 11%. And Kenya is at 8.2. This is the number or the share of people fully vaccinated, fully vaccinated and also partially vaccinated. So this is 8.2%. I'm not positive about the percentage, but the numbers are exactly from the Ministry of Health as of 2 days ago. But you can see Africa is lagging behind, and hence the continued push for vaccine equity around the world. Now, the science, of course, is rapidly gathering data on the new risk that emerged last week, and this concerns the emergence of a new variant, Omicron. But of course, before that, there were concerns of a possible return of infections, and this particularly in the advanced economies. But with regard to the newest risk, we know that several advanced economies reacted aggressively and indeed put travel bans and quarantines in place, something that we hadn't seen in a long while. In any event, the lesson from this, if we were to take a lesson from this, is that we must pull all stops and vaccinate our population rapidly. That applies around the world, but particularly from our perspective here in Kenya. It all hinges on the success of the vaccination programs. Having said that, the other item with regard to global developments is the supply chain constraints, which, while they have in part been relaxed, they still remain operative and constraining production, output, etc. And of course, putting upward pressures on prices. Secondly, there is the issue of oil prices, and I think we can see the development of Moban oil, which is our benchmark oil here in Kenya. But I think the point here is that recently the prices have come down, and I think as of yesterday it was down to $75 per barrel. Bottom line here is that these are unusually high prices of oil, and that obviously will put upward pressure, or has put upward pressure on other prices. And energy is a key component in most of production, and consequently also on the CPI. That said, inflation in the advanced economies has risen to unprecedented levels in recent times. So here is a graph that shows the inflation outcomes in the advanced economies. And you can see, for instance, in the US, they're in the 6.2 range. Other countries, Germany, that has generally had very low numbers, you can see it's up to 4.5. As a matter of fact, the harmonized CPI that is comparable to other Euro countries is at 6% for Germany, which is something that obviously is a key concern, not just for the Germans, but for all Europeans and indeed around the world. So these are stoked discussions about the stance of monetary policy in the advanced economies and the balance of risks. So that is what I wanted to say about the global developments. There hasn't been any new numbers in terms of projections of sort of global forecast, etc. So it's those issues that the MPC considered from the perspective of their decision. Now, turning to domestic economy, inflation, I think, is where we need to start, and you can see the chart. And I think the point here is that in October, the CPI was at 6.4, having fallen from 6.9 in September. By the way, we are expecting to receive the November CPI numbers today. Sometime today we'll see them. We don't know where they are, so we are waiting for them just like you are. But I think the point here is that the CPI fell in October, partly or largely because of subsidies that were put in place to lower the pump prices that's on fuel. And the drivers here have generally been fuel and food prices. As you can see, food prices in October were at 10.6, and fuel price inflation was at 9.6. Non-food, non-fuel inflation has been generally stable. You can see the green in that chart, the green bars in the chart have generally been below 3%, well below 3%. Since our last discussion, there has been a release of the 2021 quarter 1 and quarter 2 GDP data. And I think having examined this in detail, if you remember, last time we met, we only had the annuals, the revised annuals for 2020, and going back really several years. So we didn't have the benefit of the quarterly numbers that we now have. They are now in front of you, and you can see the Q1, Q2 numbers well displayed there. And you can see, for instance, they support, or they indicate that the strong rebound in the first half of 2021, and indeed the recovery has accelerated. You can see the growth rate in Q2 was at 10.1%, a number that you have seen in other places as well. Now, we have used this data for the projections. I think last time when we chatted, we told you that we hadn't we hadn't come up with revised projections based on the new data, that is the new GDP numbers. But here now we have, and we've used these quarterly numbers. We've used the leading indicators and other information that we may have, and you can see that our projection for 2021 is the annual is at 6.4, and for 2022, 6%. Those numbers are still, there are some, you could say, large, or let's say we need to refine them a little with more data and bring them, refine them a little more, particularly in 2022. But I think that on the whole, these are the numbers that we have been able to put together. There are two caveats and one question, though, about these numbers. And the first of this is, of course, Q3 data. And we expect to receive Q3 data in early December. And that will obviously give us a better handle on the projections for 2021 and 2022. The other thing, of course, is the new infections or the possibility of new infections. I mentioned them at the beginning, and obviously we haven't incorporated anything relating to that. So it is as before, meaning with the optimism that had come, or we have, or let's say economic actors have, following, say, the reopening of the economy, etc. So I think these pretty strong baseline numbers. There's a third point I wanted to raise, and actually this was asked, I was asked about this by Razia last time, Razia Khan, and she asked how aligned are our leading indicators to the new revised GDP. And I said they are generally aligned, meaning leading indicators are pretty strong leading indicators. But I wanted to show you a graph that demonstrates that. No. I think we're having some trouble. Yes, this is it. So this is the real GDP numbers, that is the blue real GDP by quarter, and again, these are the revised ones, real GDP by quarter. And if you used our composite index for, let's say, economic activity, meaning do the leading indicators and see what what came out of the leading indicators and compare that to the real GDP, that's what you get. So the green is our projection using leading indicators, and the blue is really the real GDP. And you can see there are some years, some quarters where there's a large, they're generally aligned, but there are some quarters where it's a bit off, right? So you have, for instance, Q1 of 2016. But when you come closer to 2019, and indeed even 2020, they are pretty much aligned. Of course, Q4, you can say that Q4, our leading indicators was still, we missed the turning point, if you want to put it that way. So the blue turned quickly in Q4, but indeed we didn't catch it until Q1 of 2021 with regard to the leading indicators. But I think the point is, you can see they're pretty aligned. And the last one that we have there is Q3, and that's the green, which is our, let's say, projection of where Q3 will be. And I think that is aligned to the table that I showed you before. So I hope this clarifies. I don't intend to be showing that table frequently, but I hope it answers the issue, the question that Razia asked last time, and indeed any of us would have asked. Now I want to quickly rush through the other slides regarding the developments of the economy, the real sector. And I think the first one here is about credit. I think that's where we start off. 12-month credit has increased to, this is the credit growth, 12-month credit growth to the private sector is a 7.8. And then you have the next one. Credit to selected sectors. So you have manufacturing. You can see this is the red one is the 2021 line. You can see that is much higher than, say, what it was in 2019, 2020. Transport and communication as well. You want to look at the year-on-year growth is the bars, the green bars, and indeed all the others, business services. Consumer durables are important because for two reasons. One is that it shows a bit of, well, it's part of the consumption, but it also shows optimism. So an element of optimism by the consumers, which is an important component of GDP, even I put it that way. The next slides, so the next slide was actually on sales turnovers, manufacturing sales turnovers. There it is. So sales turnover on manufacturing, you can see this is high, and this is the red numbers. You can see the growth rates are definitely very strong. And then, of course, you have the wholesale and retail trade. You can see where we are. But we expect that they'll kind of take off, particularly the wholesale and retail, with the reopening of the economy. So these are numbers that maybe you could say are put into the leading indicators to show. And another one which you can see is the accommodation and service and food services. This also will take off. I mean, you have the red. You can see it's already growing strongly, but it's just will now grow off, off the charts, as it were, with the reopening of the economy. The reopening happened in October, October 20th to be precise, and so November, December should be taking off. Transport and storage, again, these are reasonable growths, 10%, 9%, etc. And again, this also collaborate the stories. Another slide is about power generation. This is an important slide because, as I said, electricity or energy is an important component of manufactured goods, etc., an important input. And you can see the red, which is the 2021, much higher than anything else. So this is an all-time high, as it were. And the year-on-year growth, you can see, is also quite strong, 6%, 7%, etc. And if you break it into large and small consumers, you're pretty much seeing the same picture. So this collaborates strength in the manufacturing sector, etc. On cement, again, same thing. Cement production, so again, you can see already off the charts, and sort of going much further, much higher. This again, year-on-year production, all-time high, as it were, and looks like it is continuing. So those are let's say, some of the indicators that I wanted you to see that, in a sense, collaborate the strengthening of the economy, and indeed the strong rebound that we have seen in the numbers and expect to see going forward. Now, I wanted to cover the three surveys that we have. But all I'll say here is that the three surveys this time are actually very interesting. And if there's any reading that you should do, so if this was a class, somebody would give a reading sort of assignment. And I think the reading assignment is the surveys. I think they'll be posted in the next couple of days at most. So definitely, in the next 2 days, they'll be posted on our website, and you can look at them. But I'll just maybe provide an appetizer, if you will, to this surveys. The first is on the market perception survey. This is a standard survey that we have been doing for a few years now. And what it is telling us is that there is a strong optimism in terms of potential of the economy, or with regard to the economy. So, for instance, the top chart shows very optimistic 3%, optimistic 90%, and those are pessimistic 8%, and tiny element there that very pessimistic. So you can see that putting the very optimistic and the optimistic together, you have 93% level of optimism by banks. And you can see this is unprecedented in recent times, definitely since the coronavirus set in. So in 2020 and indeed also so far 2021. And the same the same pattern applies for the non-banks, even though the non-banks have lower levels of optimism compared to banks, and that has been the case throughout. So you can see levels of optimism of 75% for the non-banks, which again you can see is pretty strong in recent times. Then there's the chart about economic activity. No. Okay, we are missing it. So there was a chart about economic activity. Maybe we are missing it, that's okay. So we can, and it really, oh yes, here it is. So the question here was, what is it? I mean, how do the respondents see or their views about increase in economic activity in November, December compared to September, October. So they could answer and say very strong, moderate, weak, or very weak. So let's say 5 different outcomes, potential outcomes. So economic activity. And I think the general sense here is that actually it strengthened quite a bit in terms of the perspectives of the respondents, right? So those that are moderate, 62%, those that are strong, that meaning the economy will strengthen in November, December relative to the, could we have the slide please? Yeah, so relative to September, October. And you can see that that was now 33%. So what were the reasons for this? The reasons for this were threefold. One is, of course, the reopening of the economy. So the reopening of the economy in October really helped, and it improved the perceptions or perspectives of pretty much all actors in the economy. Secondly is the expected pickup in demand that we generally see as we come to the festive season, Christmas, New Year's, and indeed the back to school sort of, all those back to school activities, new uniforms, new books, etc. And then, of course, the decline in the COVID numbers, which, as you know, have remained, in terms of infection numbers, have remained below 1% for an extended period. And that sort of, and of course, the vaccination campaigns that have been going on. Of course, this does not capture what happened or the prospects of the new variant that we talked about earlier, but I think you can see there's strong, strong positive sentiments. Then there's the CEO survey. This is a new survey that we have been doing since, I believe, May. And just to show you one slide from it. This is a bit of a complicated slide, but I think I think it will require a bit of understanding, but maybe this is homework. If there's any homework, this will be homework. Basically, what it is, it captures the responses from the CEOs about the prospects in their company, in their sector, about the country, and indeed globally, right? So in some sense, and then from all that, you can say that the 39% of them, or I guess it's 39% of them are optimistic about their, or they're confident about the prospects in their company, etc. It goes on like that. And so actually what has happened here is that we have calculated an index based on those responses. And the index line, it is really on the right, if you are thinking of what are the numbers, it's on the right-hand side, and that is the line, the solid line, that the curving line, like the wave line, and you can see it is at its highest in November. I don't want to sort of argue how it has been calculated, but I think the point is that it is a good visual representation of the strengthening of business confidence as reported to us by CEOs in the last survey. In the document that you're going to see, this will be explained a lot more so that you can clearly understand how this is done. But again, the CEOs, their optimism was based on the same things, same factors, but easing of COVID-19 restrictions, of course, the services sector reopening, and they were the most optimistic, and of course, the continued investment by government in infrastructure, etc. So I think those were expected returns, but at least in terms of the confidence, it's quite strong. Then very quickly on the hotels, we continue to do the hotels survey, and this also showed at this moment virtually all hotels that we are surveying, and this is across the country, have reopened. So both in the rest of the country and in Nairobi. Now it's true, it doesn't mean that every single hotel is open, because we do know some, let's say, prominent hotels in the Nairobian environs that are still closed because of, let's say, some of them is because of their ownership concerns or change in ownership, etc. But this is a pretty good chart in terms of, let's say, normalization of businesses. The second chart shows the bed occupancy, and you can see this has really peaked or has really increased in October, November. October was largely driven by the school holidays. There are school holidays, and you can see Mombasa hotels were doing brisk business. As a matter of fact, they've continued to do brisk business. And I would really want to see how they'll be in December and really completed all of November, because we only surveyed them in the second week of, first and second week of November. And then, of course, but this is good numbers. Then the forward booking. The forward booking numbers you can see for December, 75%, which in some sense is unusual for those of us that, as we understand it, Kenyans wait until the last minute to do any booking. So it looks like this is, we also know that the SGR is fully booked in terms of, transportation back and forth. So December looks good. November also looks good. And indeed, going forward, at least it looks like there's some dynamism that is returning in a sector that has really been comatose for some time. Then we go on to the external sector. And if you don't mind, I'll be a bit quick. I'll breeze through some of the numbers here. So the first of this is just to tell you about the imports. So here is your standard chart. We talked about this with virtually every meeting, and you can see intermediate imports, excluding oil, that is rising, and all other components, let's say the consumer goods are also increased, and etc. So this is a good chart. The next chart is on, I believe, on exports. Okay, so it's on exports. Again, you can see strong rebound in some exports or components of exports. But I think the one that maybe you may ask about is tea. And tea, I think there are two issues here. One is the volume, but also prices had come down. And I think that is something that may recover. We are watching coffee. Coffee prices in the markets are very high because of problems in Brazil in terms of weather problems there. But anyway, so exports continue to rebound strongly. And other things, tourism, this is tourist arrivals, and the gold bars, you can see they're coming back up again. Obviously nowhere near where they were in 2020 and indeed late 2019. But I think at least now we are beginning to see some return to normalcy, creeping up gently. Next slide is on remittances. Remittances have remained very strong, and really the 12th month to October relative to 12 months, I think it's 12 months. No, it is actually the 10 months to October. The growth is 20%, 20 point something percent. It's in the press release. And so we expect another record year in terms of remittances. And this obviously has helped maintain, let's say, consumption of a lot of our people that, receiving this flow of funds from their families outside the country. Now, the next slide is on so the question then is what happens here. I wanted to sort of close with the current account, but so let's go to the current account. So the current account really at this moment year to October is at 5.4% deficit, 5.4% of GDP, and we are on track to close the year at 5.2. So you can see this is something that we have been talking about, stability in the current account, which obviously supports stability in the FX market. So going to the FX market, the slide on reserves, the adequate reserves, and you can see what happens is often we get significant inflows when the government borrows a significant amount, let's say through Eurobond or World Bank, etc. And then, of course, it's used for payment in a gradual way, etc. But the point is that at this moment, it's north of 5.5%, 5.5 months of imports, and quite adequate. In terms of exchange rate, some of you have asked about that, and I think it is important to compare ourselves. Where are we exactly? So this is a performance of major currencies year to date, as at November 25. So if you ask yourself, relative to the US dollar, where is, let's say, the Swiss franc? It's at depreciated by 5%. Or for that matter, if you're thinking the South African rand, 7 point something percent. This is again only until November 25. And Kenya has depreciated by about 3%, so 2.9% relative to the US dollar. And so those are the numbers. Now, those are sort of major currencies. But going to the next one, which is currencies that may be closer to us, and maybe beginning from the left-hand side, you have the Zambian kwacha, which has strengthened by almost 20%. This is all relative to the US dollar. Strengthened by 20%, Mozambique Metical by 17%. I hope we appreciate that actually those currencies and those economies had significant changes, I would just call them changes, in the previous year. So in some sense, there may be strengthening because they had depreciated significantly the year before. But be that as it may, we are again, obviously, we are still at 2.9% depreciation. And you can see the other currencies, both sides. So the question then about exchange rate, whether we have been out of line with other currencies, I think does not arise. I think it is basically partly and significantly the strengthening of the dollar against most of these other currencies. And I think you can look at them from the perspective of this data. At the end of the day, our exchange rate policy has not changed. And just to remind you, the exchange rate policy is really, we have a flexible exchange rate regime, and we intervene just to minimize volatility. But we do not set a direction or a level. So we allow the markets to push the exchange rate, strengthen it, weaken it, as long as there is no volatility, or let's put it this way, we will intervene to make sure that there's no volatility, because volatility definitely it can lead to instabilities and financial instability. So that's what I wanted to say about the exchange rate and indeed the external sector. Again, the current account is well anchored, and this would in a sense support stability in the FX market. A couple of quick points before I finish on the banking sector. And the banking sector, just to be clear, remains stable and resilient, quite adequate in terms of capital, liquidity, etc. And the gross NPLs, non-performing loans to gross loans, that has declined from 13.9% in August to 13.6% in October. Recoveries and repayments of note are in trade, manufacturing, personal household, financial services, etc. But I think the points to mention are really, we've seen since the last discussion that we had, and indeed, maybe we should say the second half of this year, banks have begun raising additional capital with the intention of supporting lending in 2022, and also financing emerging opportunities in Kenya and around the region. And one of the things we have seen is, for instance, there was a recent agreement on SME funding, SME financing of about 6 billion Kenya shillings between the European Investment Bank and Cooperative Bank. And again, this is targeted to the SME sector. And then other things which we could mention, but I think the only thing I want to flag, an additional thing now, is that we did issue guidelines on risk management and disclosure frameworks in terms of climate-related risks. So the management of climate-related risks. And I think this is something that has been taken positively and welcomed by the sector, and indeed others that are looking into this area. In some sense, it underscores Kenya's leadership in not only, of course, as you know, in digital money, etc., but rather on climate-related financing. Then the fiscal deficit. I think this was one of the things that was quite, let's say, was very positive in our discussion. So the implementation of the fiscal budget, really. And I think the point here is that revenues have rebounded, have performed very well. And for the period to October, ordinary revenues were higher than target by 16.6 billion. This is new. This is a space that Kenya has never been in, where actually revenues are doing better than projected. Now, the point is that, and we probed this, it's not that revenues were, there was were sort of under projected. No, they did correct projecting, but I think it is the effort on the tax authorities and indeed partly the better performance of the economy that is leading to this better than targeted revenues that will support the budget. Now, we could talk about expenditures, but I think the point generally is that the government is continuing in terms of implementing the various initiatives under the economic stimulus program and the economic recovery strategy that had been announced earlier, and that also supporting demand in the economy. The reduction in the fiscal deficit that was anticipated obviously is on track, and this is expected to stabilize public debt. And this is important. So in terms of moving ahead, the fiscal deficit is one that, the sort of evolution of the fiscal deficit is one that obviously we are watching closely, but I think so far it points to good progress to achieving their target. So that's something that I thought would be important to mention, particularly because we had talked about abracadabra financing or budgeting, and now we are living within our means. In terms of finalizing, two things to mention: the yield, the borrowing by government in terms of the domestic borrowing that has gone as per plan. The target for the year is 662 billion Kenya shillings in terms of net domestic borrowing. And this has been going well. And I think in terms of the measures quickly, the yield curve, this is the general yield curve, and you can see the green is where we are in November. And before that, in previous years, you have the dashed, the dotted black line. That was a year ago, and 2 years ago is the red line. The point is that we have had a very stable yield curve, and this has helped maintain, let's say, confidence and indeed maintain sort of stability in all other markets. One of the interesting things also is that the average time to maturity for bonds has increased from 7.5 years in June of 2019 to 9 years. So just in 2 short years, going from 7.5 years average time to maturity to 9 years. And that, I think, is phenomenal in terms of also maintaining the yield curve, stability in the yield curve, while also doing this. The ratio of T-bills to bonds has also fallen from 34%, or 34-66, so 34 to 66, meaning T-bills 34%, bonds 66, and it's gone to 1882. So 18% T-bills, that's about half of where it was before, to 82% in terms of bonds. I think these are remarkable achievements in terms of stability in the government borrowing program. The last point to make is you are aware of central bank amendment bill that was approved by Parliament a few weeks ago, a couple of weeks ago really, and this is to provide the central bank with the authority to regulate the digital lenders. And this is something I think which has been long overdue, but we've come all this way, and we are looking forward to its becoming really law, and ourselves moving ahead to managing or fixing this lacuna that has been there for quite some time. I'll stop there and take your questions. Thank you very much for your attention.
Excuse me, of the Central Bank of Kenya, Dr. Patrick Njoroge, with his remarks. And so we'll go straight into the questions. We begin with David Habling of Bloomberg News. And David asks, what will be the estimated effect of the planned inflation adjustment on excise duty on overall inflation once the levy takes effect? Second question is from Jimmy Mbogo of Business Hour. Are we likely to see regulations around interest charged by digital lenders when the regulations come into effect? The final question in this batch is from Kefa Njoroge of Radio Citizen. The president directed a rise in the limit for large cash transactions. How far has this review gone, and would the CBK see the same outcome to that premise?
Okay, so thank you very much for these questions. So in terms of the inflation adjustment, I think we had discussed this last September when these measures were, let's say, put on hold. And the measures here were the excess duty, etc. So when they were put on hold, we did do a calculation and we told you what the impact was. I would suggest kindly for you to go back and look at what we said then. By the way, we remain on the history of all these discussions, let's say press briefings, are available on YouTube and other places, including on our website. So in some sense, you can always go back there. So I would encourage you to do that. On the second one, the regulation around interest charges by digital lenders, I don't know what this really means. If you mean ourselves having sort of like caps and things like that, obviously the answer is no. We are not going into that part of the world again. We already explained why. But what we do is, what we will do and have been doing, say on the banking side, with regard to banks, is ensuring that the pricing is appropriate. And it's appropriate in many ways. And I think you have already seen what we have done on the banks. And we've talked about the pricing principles that we have. We've talked about things related to how they should treat customers. So I think that's really a good model to start from. It doesn't mean that it will sort of be translated, word for word, but definitely the direction is clear. So let's wait and see. Let's wait and see. We haven't yet we haven't yet got the authority to regulate. So whatever we say today is speculation. So let's wait for the final, final authority, and then we can have the conversation then. The last thing is about, I think it's Njoroge Kefa who is asking about the limits on large cash transactions. I think that matter is still being dealt with in the central bank. I think we have to make a good judgment, based on all these concerns. But I think what I would want to underscore is the concern that is there. We share some of these concerns, and I'm sure you too. For instance, the issue of the way you are treated when you come to the bank. If you are somebody who has a regular set of transactions with a bank, by now they should have known you, and they should also know what sort of level of transactions. There's a history there that you conduct and why. So there's a know your customer sort of issue. It's not that they should know you, they should begin to know you every single time you come. No, there is a history. So does that benefit them in terms of your relationship? Or in some sense, are you being, let's say, profiled when you come there? And so in some sense, everything that you're doing, you begin from being profiled as a thief and etc. Obviously that, let's call it even harassment, is obviously not something that we support, and I don't think anybody would support that. So I think the relationship between the customer and the banks need to improve. And from our perspective, we did talk about this a couple of years ago when we talked about customer centricity. So the bank needs to be customer centric and appreciate what the customer is doing. What business does this customer do? If indeed I'm just a salaried employee, and then suddenly I bring in 1 million shillings or even 500 randomly, right? That should raise flags. And I'm required, the bank is required by let's say the POCAMLA law. This is the protection, prevention of money laundering and financing of terrorism act. They have to sort of put out, to flag that in terms of suspicious transaction, etc., for investigation by the authorities. So there's a lot of work that is being done there. And I think, to me, it is not just, it's not a sort of a, tick box affair. It's one that needs to be dealt with correctly. I hope I've answered your question to your satisfaction.
The second batch of questions, we begin with, excuse me, Churchill Ogutu of IC Asset Managers. Churchill asks, what's the progress of rolling out the upgraded Central Securities Depository to anchor the interbank market? Back to Jimmy Mbogo of Business Hour, asking to address concerns that the directive to delist defaulters from the CRBs will be counterproductive. And then macroeconomic one from David Herbling. What informs your projection that agriculture will contract this year? What needs to be done to stimulate growth in this key sector?
Okay, so starting with the first one, I don't think thank you, Churchill. The question here is the central bank is in the process of putting in place a central securities depository. And this will allow us to have in that depository all, let's say, the securities that are there, and allow us to also support the transactions that take place in other fora, in other places, like in the securities market, the Nairobi Securities Exchange, etc. The point is that this will in effect revolutionize the way we handle securities. And it will, in the first instance, in terms of security, meaning making sure that everything is in one place, that is assured, but also other things like liquidity management. Banks and other actors will now be in a much better position to manage their liquidity. As a matter of fact, liquidity will increase in the system because of this, because of the assurance and very quick turnaround time of this thing. So we've been putting it in place. We hope to have it sort of launched maybe in the second quarter, so April, let's say, of next year. But again, there's a lot of work that needs to be done in the next 2 to 3 months. But we're at a critical point, as a matter of fact, in this, meaning we are now really putting the big pieces together. So we are very excited about that. So let's leave it there. It will also do other things, like you mentioned, anchoring the interbank market. But I think the point here is that let's do it correctly. It's important to do it right, rather than to do it quickly. So doing it right. Jimmy is asking our concerns about the delisting of defaulters. I think, Jimmy, you could look at the press release that we put out. The press release was quite detailed, explained the concerns that on all things. What are the issues around the CRB? Let's say, in some sense, temporary putting a hold on it, listing, and how are we going to do it? And I think the point here is it was really meant to support the smaller transactors, people that have that have borrowed less than 5 million. And basically the point here was it will allow them to recover during the COVID period and repay. So they can borrow, repay. It will not be held against them that they have, let's say, a loan that is less than 5 million, which has not been repaid during this period, this COVID period. So we explained it there. I don't think I want to repeat it, because you can just read it there. The projection about agriculture, I think there is a lot that is happening in agriculture, David. And I think the significant element here is something related to climate, right? Climate, or rather the weather. I don't know if you've traveled around the country and seen some of the developments in terms of livestock, in the arid and semi-arid areas. And indeed also in the breadbasket, in terms of what the level of the yield, because in some areas actually the rainfall was not sufficient. So it's more that, but you need to appreciate that last year was a bumper year. So that is really the point. So you're coming from a high base, and that is the high base of 2020. And 2020 actually, agriculture supported us dramatically. So in a sense, you would say normalizing. And hence those two factors really are the ones that underscore the projected, as we showed it to you, a slight reduction in growth in the sector.
So the final batch of questions, we begin with David from the institution of Kusoko. Your GDP growth looks ambitious from the initial estimate of 6.1% now to 6.4%. What will be the key driving factors to this? Jorge Bulutsa from Reuters News says, you said remittances are set for another record year. What is a dollar projection figure? And there's a third question, which you're just putting up, from David Ndeje. The World Bank's recent report on remittances noted that the cost remains high for a majority. Is the regulator fast-tracking some initiatives to lower the cost?
Okay, so I don't know about the ambitious growth, so maybe I'll turn the question to you. Which sector do you think we are, according to you, we are kind of very, very optimistic or excessively optimistic? So I'll turn it to you in that way. Because we've done, in my view, a pretty good job in underscoring, and this is why we put it out there, so that you can actually have a conversation with us about why this sector, you think this sector or that other sector you think the growth wouldn't be that high. But I would rather not sort of go into just a general number, sort of the bottom line. The bottom line is really taking into consideration many other developments. So I would rather we go sector by sector, and so I turn that to you. Which sector is it that you have significant concerns with, and you think things will be worse than maybe we're projecting? George's question about remittances, we do have a dollar number, but I think at this moment you can actually roughly just eyeball it. So let me not quote a number which in a month you're going to shoot me down for, right? So I would rather leave it, but I think it is in the projections. The projection we had, if I may be honest on this, there. Thank you. So I think the number we have here is not actually one that I want to give out because it is actually low-boring the numbers and it has not fully incorporated anything. So give us a bit of time and see what the November number will be.
Question, Governor, from
Yes.
David Ndeje,
Yes,
World Bank's recent report on
Remember
remittances. Yes.
So, David, what I would suggest is the following. We are actually doing the issue of cost is a big concern for all of us, not just Kenya, but around the world, right? Those countries, the emerging market countries, or those, let's say, large recipients of recipients of large remittances. So cost is important. As a matter of fact, as part of the SDGs, the the expectation is to bring down the cost to less than 3% by 2030. Now, from a point of view of Kenya, it's come down to around 7%. I think it's around 7%. But I think it's still varied. So there are things that we are considering, but I think the first one was first to figure out what exactly is going on in the sector. And so we have, as you know, done a diaspora survey, which we have put together the results, and hopefully in the near term, in the very near term, these numbers will, the results of this survey will be out there. And I think it will start that conversation about diaspora remittances and how to strengthen them. Not so much just volume, if from the same amount, maybe in terms of cost, in terms of speed, etc., security, etc. So that's what I would say. But obviously, we do have good ideas in terms of lowering the cost.
All right, thank you very much, Governor. That brings us to the end of this morning's into this afternoon's Post-Monetary Policy Committee press conference. We expect that this one is the last one of 2021. And so with that, we wish you a good end to the year, happy holidays, and we hope to see you when we reconvene early next year. Thank you and good afternoon.